Okay, good afternoon, everyone. Welcome to another episode of Phillip Trading Podcast. So my name is Junior here. So today we're very happy that we have Daniel on here. Daniel has started his career trading commodity futures back in 1985. He went on to be a gold dealer in 1989 before joining Standard Chartered in 1992, where he traded mostly US futures as well as foreign exchange and became one of their vice presidents. He is currently contracted to the CME Group as an independent speaker for the Asia Pacific region, as well as for the Frankfurt-based Eurex. He is also the author of The Accidental Trader, and a book now is available and can be sold and you can find in both Singapore and Malaysia. Yeah, so today, he will be giving us a preview on his webinar on 4th of November, which he will discuss about the US tapering and how it will have impact of the US equity markets. So for those who are very interested and want to learn more about foreign market and also keen to know about how tapering is very important and direct effect on the US equity market, you all are invited and feel free to join our webinar of tapering and impact of in US equity markets on 4th of November. You may find our registration link in our official website. Yeah, so that's it. Let us welcome our guest speaker, Daniel An. Daniel An, how are you?
Thank you very much. Good afternoon to you, Junior.
Yeah, good afternoon. Good to hear that. So Daniel, now I will pass all the session to you to share about preview on the tapering in US markets. All yours, Daniel.
Thank you very much, Junior, again. And a good afternoon, good day to all of you, wherever you're logging in from. My name is Daniel Ang. I've been trading financial markets since 1985. So this year marks my 36 years in the business. I'm very passionate about what I'm doing because at the end of the day, we do understand that things do change over time and we are living in a very interconnected world. In the upcoming webinar on November the 4th, we will be concentrating on US equity indices, in particularly how you can take advantage of the CME Micro E-mini equity index futures to actually capitalize on what is actually happening in US equity markets. We all know most investors are very much in tune with stock markets, with stocks and shares. However, there are more than one way to participate in equity markets, and that is one way to do so is through futures contracts traded in organized exchange such as the CME. Okay, and I want to spend some time to talk about what is currently happening in the US equity market as well as globally, because at the end of the day, US equity market is probably the largest and the most liquid equity markets in the world. And what happens in United States obviously will not be contained within the border of the US. It will be worldwide. At the end of the day, we are living in a very globalized village, and things that happens in the US definitely will impact us, whether we are trading or not trading US equities. For those who are trading local domestic equities, you will still be impacted indirectly by what's happening in US equity market. So it does make a lot of sense to know what is actually happening. Of late, since March this year, we have been very much aware of the inflationary pressure growing in the United States. And we can also feel it on our shores. And at the end of the day, globally, inflation is now a major concern among major policymakers as well as governments. And we are in that phase in which for the last 6 months or so, we have been told that inflation is just temporary, especially coming up from the US Federal Reserve Chairman, Jay Powell. He says that inflation in the United States is transitory. What it means is that he don't believe that inflation that we are seeing right now in the States for the last 7 months or so is permanent. Okay. However, he did not define his time frame. What does it mean by temporary? Does it mean a couple of months, or does it mean more than a year? Okay. And the figures that we are seeing of late is that it does suggest that inflation is probably here to stay. And there's a lot of things that's going to back up this assessment. And we're going to be talking a little bit about that, especially on November the 4th. So today's podcast is just going to give you a highlight of what I'll be talking about, okay? If you can see my screen right now on my PowerPoint presentation, you can see a slide called the US GDP annualized. Okay, this is a report that was released last night as the US Bureau of Economic Analysis from the US Department of Commerce released this number. You can see that there is a couple of bars on this particular slide itself. And I'll draw your attention to the very last bar on the very right. Okay, it shows a 2% growth on Q3 2021. So it does shows that after the spike up in the the third quarter of last year, it means to say that year on year, this time last year, US GDP actually spiked up to 33.4% after a massive drawdown of 31.4% as a result of the pandemic itself. Okay, but since then the US GDP has more or less normalized back to more normal levels. We all have to understand that US is a very mature economy. To have GDP anything upwards of 5% is a little bit unnatural. Okay, so what we have been seeing so far up to the second quarter of this year, that the GDP in the US is actually doing relatively well. Okay, you can see that Q2 is 6.7%. Okay, now for a very mature economy like the United States, that is a fantastic number. Okay, however, we are seeing a climb down from those extraordinary growth rates. Okay, last night we saw the third quarter GDP released by the US Department of Commerce, showing that US third quarter GDP is only at 2%, which is a major disappointment because the market was expecting at least a 2.8% growth in the third quarter. So this is probably the lowest growth rate since the start of the recovery from the pandemic at the end of the third quarter of last year. Okay, so what major implication does it has? It has a huge implication. We are already in the last quarter of 2021. Over the next 2 months or so, we will be wrapping up the year, and we will be able to see what is the fourth quarter GDP performance by the early months of 2022. Okay, so we are looking forward as to whether the US economy is on an even keel. Now, what is bothering the US economy and as well as their policymakers is the inflation that we are seeing. Okay, like I said earlier on, inflation starts to peak. Okay, starts to surface at the end from the start of the first quarter of this year. So I want to show you this particular chart itself. Okay, now you can see that as a result of the pandemic, you can see that this chart here shows the inflation hits many fronts. Okay, of course we are more familiar with the term called CPI. CPI refers to Consumer Price Index. Everybody understands what Consumer Price Index means. It means it is a measurement of price within a economy itself. Okay, so beyond the CPI numbers, there are other metrics in which we also have to be aware, because it is not simply just a CPI. There's a lot of factors. Now I want to introduce this thing called the monetary inflation. What is monetary inflation? As a result of the 2008 and 2009 financial crisis, as a result of the subprime crisis analysis, if you can still remember, that happens about 12 years ago. Okay, and as the US economy went into a tailspin and went into a recession, the then Federal Reserve actually launched a couple of moves that is both conventional and unconventional. First, they cut interest rate down to almost zero, and it has been stuck there for quite a number of years. At the same time, they also launched what we call quantitative easing. What it means is that the Federal Reserve has been aggressively in the market to buy up assets. Now, this called assets is actually debt instruments issued by the US Treasury. Okay, we have Treasury bills, Treasury bonds, Treasury notes of different denominations. As you all know, US Treasury periodically will issue debt instruments to finance their operation. Okay, there are short terms as little as maybe 30 days bills to something like 1 year note, 5-year note, 10-year note. And of course, we have the long bond in the 30 years bonds. Okay, so they all expires at different duration for different purposes. At the end of the day, what the Federal Reserve did was to buy up all these assets, and you can see that, in a sense, people were calling it printing of money. But these days, there's no need to print money because money now has gone digital, and all the Federal Reserve need to do is to create the funds available to buy up all these assets. Now, from before the 2008 financial crisis, US Federal Reserve balance sheet was below $1 trillion. Okay, right after the onset of the 2008-2009 financial crisis, you can see the Federal Reserve pump up the amount of liquidity into the market to make sure that in the marketplace there's enough liquidity to make sure that those companies that need funding will be able to get cheap funding, and lots of them. Okay, so that was the original idea why they went on this quantitative easing measures. Okay, however, as you can see that it's not just one round. There are actually 3 rounds of quantitative easing. By the beginning of 2015, you can see that the amount of assets under the Federal Reserve has gone up from almost under $1 trillion to $4.5 trillion. That's almost a 4.5-fold increase in terms of the amount of liquidity they pump into the financial markets to make sure that everybody who needs funding will get funding. However, the money didn't get to resuscitate the economy in the way that it was intended. Okay, the money was slogging around in the financial systems, and most of the money found its way into the risky assets. Now, if you are a bank in the United States, interest rate is almost zero. It's as good as free money, and there are tons of them. What you do when you have this access to this massive amount of liquidity? Instead of lending out to businesses that need funding, the banks are in the business whereby they will like give out loans to make sure that companies and individuals who need the fund can get access. However, during the period in which the quantitative easing was in place, okay, right after 2009, was that the banks take a look at their customer base and they say, look, your company is not doing too well, or to the individual, your credit score is no good. And so what they did was they did not lend out as much as they would have loved to because they do not believe that the customers will be able to repay them. So what did they do with the excess liquidity? They pumped almost all the excess liquidity into risky assets. There was a period of time everything, just went up in value. Okay, and of course the stock market is a major beneficiary of this massive amount of liquidity slogging within the systems. Okay, so when Janet Yellen, which is the current US Secretary for the Treasury, she was the chair for the Federal Reserve at one stage, and she said that, look, this thing got to be normalized. So what she did, together with Ben Bernanke, which was also the Fed chairman at one time, was to normalize, means to say they want to slowly reduce the amount of liquidity into the market by buying back all these assets, okay, which is exactly what we are talking about right now, in which there is this huge inflationary pressure, and most experts were saying that the Federal Reserve will have to stop slowing down the asset purchases. I will come to that later on. Okay, what happened was during the phase when the market was quite stable, the Federal Reserve started to taper. Okay, when they taper, they bring down the asset they have at their disposal, okay, by buying them back. So at one stage, from more than almost $4.5 trillion, the amount of balance sheet in the Federal Reserve account was actually drawn down to 3.76, just before 1 quarter or so before the pandemic hit. Okay, when the pandemic hit in early 2020, so the Federal Reserve have no choice but to bring interest rate down back to zero, and then at the same time launch another round of QE. This time the QE is massive. It's even bigger than the last 3 QEs that they did before the pandemic. Currently, as of last week, the amount of balance sheet within the Federal Reserve account has ballooned to $8.57 trillion. This is not the latest figure, but it's the only figure that I have up to date. Okay, it reflects October to 20th, which was last week. So it looks like the curve looks like it is nowhere near the top yet. Okay, and right now the market is saying that, look, this is totally unsustainable in view of the inflationary pressure that we are in right now. So the Federal Reserve have been talking about tapering, and we all know in October we do not have any FOMC meeting. FOMC means it is the Federal Reserve Open Market Committee, whereby they will decide on policy move as to how to get the economy going, how to control price inflations, and all those stuff. Okay, so the next and the last FOMC meeting will be on the early part of November. Okay, so a lot of people are expecting the Federal Reserve to actually do something concrete about it rather than just talk about it. Okay, we all know the Federal Reserve chairman has already signal to us that they are not likely to hike interest rates, because one of the most direct impact they can do is to raise interest rates to make it that to normalize the interest rate, because right now we have ultra low interest rates, which has become a real problem, which is creating a lot of asset bubbles in a lot of places. Not only in the stock market, you're also creating bubbles in the property market in the US. And elsewhere, you can see even in Singapore, we are beginning to see that, despite the slowdown in the economy, property prices are not coming down. Of course, in Malaysia, you have a different set of dynamics in play, may not necessarily be mirroring what we are seeing in the States as well as in Singapore. But by and large, you can see that low interest rates, if you cap it for too low, it's going to create a lot of bubbles. Okay, so this is where we are right now. Okay, then of course, during the last FOMC meeting, which was in September of this year, the Federal Reserve Chairman Jay Powell has actually says, I think if the economy continues to progress broadly in line with expectations, I think we can easily move ahead at the next meeting. What does it mean, move ahead? He's talking about tapering. Okay, right now the US, or rather the Federal Reserve, is buying $120 billion in terms of assets, and this asset consists of US Treasuries issues as well as mortgage-backed securities. Okay, and they are talking about slowing down this asset, maybe from $120 billion a month, maybe to maybe 100 billion or maybe even lesser. So the market is expecting them to move in the next FOMC meeting, which is only it's only a week away from now. Okay, and then this is exactly what he said. He also recognized that inflation is a little bit more persistent than what he expected at the beginning. In the middle of the year, he was saying that inflation is not going to be an issue. It is within control, and it looks like it's going to be transitory. Okay. However, after 7 months, we still see inflation pressure is still up there, and it's not necessarily coming down. And now he is shifting his stand and say that instead of hiking interest rate in 2024, he will bring it forward to 2023. However, whatever we are seeing in the marketplace today in terms of swaps, okay, we can see that the market actually believes the Federal Reserve may be forced to even start raising interest rates as early as 2022, not once, maybe twice. Okay, so this is how is affecting the marketplace right now. And if you can see equity prices of late, you can see yesterday was the release of the GDP number, which was a disappointment. However, right now we're in the middle of earnings seasons, and earnings season has been pretty good for most of the large cap companies. Okay, you can see Tesla, for example, you can see their stock value has actually gone up, and he has made Elon Musk $23 billion richer over this short period of time. And we can see that movement is going to be impacted. Okay. Now, this is the latest movement in the Dow Jones Industrial Average. I did this chart yesterday afternoon, so it is not the latest. I did not take into consideration the closing price. However, you can see the trajectory. Okay. The last when I checked was above 25,000, almost 500. Okay, this is the cash markets in terms of the Dow Jones Industrial Average. You can see that the market, if you look into the box on the right of this chart, you can see that the market has been on an up and up. So this gradient suggests that technically it looks like the market is still have a little bit more room to go before it actually slow down. Okay, so the question is, what will the tapering, if it happens, okay, will do to the stock market? Okay, so if you have a view, then you can take up positions via the CME Micro E-mini Equity Index Futures to take advantage of whatever opinion that you may have. I will be sharing my opinion on the November the 4th webinar itself, in which I will give you my opinion based on longer term, which is the monthly outlook, the weekly outlook, and then I'll zoom down to the daily outlook for all the 4 major equity index futures that the CME has to offer in terms of micro E-mini. Okay, so there's a lot of things you can do because all the 4 indices do reflect slightly different sector of the markets. The Dow Jones, of course, is the large cap index. Okay, 30 stocks make up this index itself. So it is a major index that has been that will be watched by fund managers. So these are big time players. Okay, because if they move, we can see how the Dow Jones will actually react. Actually, I want to show you is that the move currently in the equity markets is goosed, okay, very much by the QE program that the Federal Reserve has enacted. So this QE again is an exercise in which they pump a lot of liquidity into the market. And we can see ever since the pandemic strike, okay, and ever since Biden became the 46th US president, he has launched not just the monetary policies, he has also got his Treasury Department to actually launch a series of stimulus packages, what we call physical physical policies, in which together they have more or less stabilized the US economy. But what they did is creating the seed for the next crisis. Okay, we have always seen over the last few decades, okay, I've been in business long enough and I've seen how policymakers solve one problem but create even more problems for the future. So right now we are seeing this being replayed again in real time. Okay, so going forward, there's going to be a lot of volatility and there's going to be a lot of opportunity for those who can understand what's happening and can take advantage of these moves. Okay, so you can see the move in the green cut in the shaded area of this chart itself. You can see that I've shaded an area beginning from 2009, and this is exactly the low of the US subprime crisis. And from that point onwards, since they launched the QE program up to the present day, you can see that this market has been on an up and up, and everything got to do with the QE program because there's so much liquidity, and all this liquidity has found their way into the US equity markets, and that in turn, okay, spill over to global equity markets. So this is the only reason why US equity is on an up and up. Over the longer period of time, if you have a yearly chart, you can see that this is a major move that even with a significant correction, which I think is just around the corner, okay, will not be able to break the backbone of this bull market. So what I'm saying here is that I do expect some kind of significant correction in the next couple of months, okay? And if that happens, it could probably last all the way until the end of 2022. Again, if the market do correct significantly, okay, I think it is still a buy market because at the end of the day, money has to find an outlet. And the only outlet right now, if the US going to maintain the QE program, which I think they cannot do without. The US and the major economies are so addicted to debt, they have no other way out. Okay, they will have to continue with the QE program, and each time they launch a QE is going to be even bigger than the previous one. Okay, so that means going forward over the next decade or so, we're going to see US equity rolling back to new high. I am very confident to tell you that whatever the current level of the Dow is over the next few at least a decade or so, is going to double in value. Okay, so this is exactly what I'm going to see, because short of a war, okay, a war means a shooting war that leads to something very catastrophic like a World War III. Okay, I believe the path of less resistance right now is for the Western powers, especially the United States, to continue on this current path of quantitative easing and ultra low interest rate, because they have no way out. If they're high interest rates, they're going to blow up their national debt. Currently, the US national debt is huge, in excess of $28 trillion. So just a quarter point increase of interest rate is going to add a tremendous burden on servicing those debts. So there is no way they're going to be able to high interest rate for any prolonged period of time. So they will have to revert back to quantitative easing when the next crisis hit, and it will come, okay? So this is the S&P 500, which is the other major index. This is a more broad-based index that has 500 stocks within the components of this index construction. Okay, you can see that the structure of this move is exactly the same as what we are seeing in the Dow Jones Industrial Average. Currently, the price is at 4,574 as of the time when I was doing this chart. Not the latest. You can see that compared to the Dow Jones itself, you can see that this market from the low of 2009 has gone up fivefold, and this is very scary. And but this is by means not the most aggressive index. You want to see what is the most aggressive? The next chart will give you an idea. This is the one, the Nasdaq Composite Index. These are made up of tech stocks, including all the FANG stock. We have Facebook, Amazon, we have Microsoft. They are all included into this Nasdaq Composite. You can see that from the low of 2009, this market has already gone up tenfold. Tenfold. Can you imagine your stocks, if you held on to your whatever you bought, especially tech stocks back in 2009, it will be worth 10 times more. And it looks like based on the current earnings situation, it looks like the Nasdaq has already gone back to new high. This week itself, we have all these three indices. We have the Dow Jones, the S&P 500, and Nasdaq charting into new high. However, I don't think this is sustainable, because technically there are something at play which doesn't give me a lot of confidence to say that this rally that we are seeing is going to be sustainable for any prolonged period of time. In fact, I'm beginning to turn towards looking to for significant corrections. So this could means that as my experience can tell me, okay, I managed to catch the 1987 stock market crash, and that was at that time so majorly impactful that, you know, if you have not long, if you're not go long the US equity index, then okay, you can make money faster, shorter in a shorter period of time, okay, during a correction. Okay, short market always move faster than a long market. What it means, the law of gravity do not change in financial markets. It will take a lot of kinetic energy to push up the value of anything. However, it takes only a very short time, okay, for the market to correct, to come off. So anything that comes off will come down at a rate that's so much faster than the rate in which it climbs. This stock market has gone up for 12 years, 7 months, and today will be 23 days. Okay, so it is still counting. So if you have not bought equities over the last 12 years or so, fear not, because if the market do corrects, you can make back this move in just a couple of weeks, in not months. Okay, so stay invested, because at the end of the day, this is exactly what's happening in the market, whether you are involved in any kind of trading at all. Okay, whether you're an investor, whether you're trading, it doesn't really matter, because at the end of the day, this will happen and you have a choice. You can either be a victim and accept what comes may, and that means to say that if this is an inflationary phase which you are facing, which I don't believe is going to end anytime soon, okay, then you will find that the amount of income that you have is probably stagnant, cannot catch up with inflation for one, and then you can find that your disposable income is shrinking. For the same amount of money that you make, you're buying less and less products and services, and that will not only impact you, it will impact your family, and how you manage your wealth is going to be very much dependent on how inflation is moving if you do nothing. However, as investors as well as traders, we could take advantage of this happening, because at the end of the day, the world will continue to move, okay, with or without us. So we have a choice here, whether we want to be a victim or whether we want to be able to, you know, base our knowledge of financial markets and be able to make something out of this. Okay, I for one has always believed that financial markets is a gift to all of us who understands how to actually capitalize on market movements. Okay, so this is just a highlight of what I want to share with you on November the 4th. There's a lot more, okay? And I want to encourage you to, you know, sign up for this upcoming webinar in which I will share my views with you. Junior, back to you.
Okay, thank you very much for the fantastic sharing on this preview, Daniel. That is very, very interesting. And if you are now trading US market, trading foreign market, I would say just now the Daniel sharing the GDP, inflation, and federal balance sheet, which is very, very important that you want to look into it. So now you're very, very interested to know more about how they will impact in the US equity market. Yes, you can find our registration link in our official website. So thank you all. Thank you, Daniel, and see you on November 4th. Thank you. Bye-bye.
Bye. See you then.
Yeah.